Welcome to the Deep Dive. Today we're unpacking the ARKO Core second quarter 2025 earnings call. This one dropped after hours, August 6th.
Yeah, and it was definitely a critical update.
Absolutely. And the story, frankly, is a lot more nuanced than just the headline numbers might suggest.
It really is. Especially when you think about the macro backdrop ARKO is dealing with. Management, they were pretty upfront about it.
What did they say?
Well, you heard the usual suspects, right?
Yeah.
Persistent inflation, geopolitical stuff, but really the key was restrained consumer spending.
Which means folks are watching their wallets.
Exactly. More price sensitivity, people shifting towards value. That's the environment.
Yeah, if you're tied to gas and convenience items, that's gotta hurt. But despite all that, the message seemed to be about execution.
Totally. Disciplined execution. They kept talking about focusing on what they can control.
Yeah.
You know, costs, getting the merchandise mix right, and really pushing those loyalty programs.
And it seems like that internal focus is, well, what the market really keyed in on.
I think so.
Okay, let's get straight to that market reaction then, because that tells a story right away. The stock moved up pretty significantly after the print.
It did. Saw a nice positive bump. The market seemed happy.
But when you dig into the actual numbers, it was kind of a mixed picture, wasn't it?
Oh, definitely mixed.
But
the profitability angle just seemed to outweigh everything else. So GAAP diluted EPS came in at $0.16.
okay.
And the key thing is that beat the consensus estimate of EZ01 12 towns by a solid 33%. That's a big beat.
A 33% beat, yeah, that gets attention. But the top line?
That's where the mix part comes in.
Yeah.
Revenue was $1.999 billion. Just missed the consensus, which is around $2.04 billion.
Okay, a narrow miss, but year over year.
That's the kicker. Down 16.3% year over year. Pretty steep decline.
Wow, okay, so revenue down significantly, EPS way up. What about EBITDA?
Right, the profitability anchor. Adjusted EBITDA landed at $76.9 million. That was actually slightly down year over year, but crucially, it was above the midpoint of their own guidance.
So they delivered on their own profit forecast.
Exactly. And the market basically said, okay, we see the revenue drop, but we like the profit execution and the strategy. Confidence in the plan, basically.
Right, because that revenue decline is largely driven by this big strategic shift they're making, this dealerization thing. The market's prioritizing the quality of earnings, the margin expansion.
Precisely. So let's unpack how they got that profitability, because the margin story was really the highlight of the quarter.
Let's do it. Where did the strength come from?
Okay, first, merchandise margin. Expanded 80 basis points year over year. Hit 33.6%. That's pretty strong.
And how they manage that with consumers being so price sensitive.
Management pointed to two things. Optimizing the category mix, especially pushing OTP.
Other tobacco products?
Right, higher margin stuff. And using targeted loyalty-driven promotions rather than just broad discount.
Okay, let's pause on OTP for a sec. Just remind us why that's such a key lever. What's the margin difference like compared to, say, regular cigarettes?
Oh, it's significant. OTP includes things like smokeless tobacco, cigars, vaping products. Generally much higher gross margins than standard cigarette packs. So if you can shift even a small percentage of sales into that category.
It lifts the whole average.
Exactly. It's smart merchandising. Better use of that shelf space, essentially.
Okay, makes sense. Now, fuel, that's always the volatile piece, right? Retail fuel margin was, what was it?
Really strong. 44.9 cents per gallon. That's up 3.3 cents from last year.
45 cents a gallon, that's huge. But hang on, didn't same-store fuel gallons go down, like, quite a bit?
They did. That's the tension right there. Same-store gallons declined 6.5%.
So how sustainable is a 45-cent margin if volumes are dropping that much? Isn't that a risk if people just stop buying gas there?
It is absolutely the core tension. You're right. Historically, 45 cents is, well, exceptional. You usually see that only when things are really tight supply-wise or competitors are struggling. ARKO is clearly prioritizing margin dollars over volume.
So they're willing to sell less gas, but make more profit on each gallon sold.
Seems to be the strategy. Serving maybe a less price-sensitive customer or just managing their costs and pricing really effectively at the local level. If they can hold close to that margin level, the volume softness is manageable.
And I guess the wholesale side helps smooth things out.
That's the beauty of the model they're shifting towards.
Yeah.
The wholesale segment actually saw operating income increase year over year. Total gallons were up 3.9%, mostly because of this channel optimization program we need to talk about.
Okay.
And that wholesale fuel margin, the really predictable part, 10.1 cents per gallon, stable. That's the foundation.
Right. Which brings us nicely to this whole dealerization strategy. This seems to be the absolute core of their transformation. It's where things get really
Hence
interesting.
the strategy, full stop.
Explain it simply. What are they actually doing?
Okay, so they're taking company-operated retail stores,
Hmm.
the ones where ARKO employs the staff, manages inventory, deals with all the operational headaches,
Yeah.
and they're converting them into independently operated dealer sites. ARKO basically steps back from running the store day to day.
But they still own the property or supply them.
Often they retain the property, becoming the landlord, and crucially, they become the exclusive fuel and merchandise wholesaler to that dealer. So they swap messy retail operations for predictable, high-margin supply contracts.
Trading operational complexity for wholesale consistency.
You got it. And the pace they're doing this at is, well, it's pretty staggering.
How fast?
They converted another 70 stores just in Q2. That brings the total since they started this push mid last year to 282 stores.
282. And the target?
The plan is aggressive. They're aiming for over 500 stores, probably within the next 12 to 18 months. So this program runs well into 2026. It's fundamentally changing the company.
Okay, that sounds like a huge undertaking, converting hundreds of stores. What's the financial payoff they're expecting for all this disruption?
It's significant. They put numbers on it. Once it's fully scaled, they expect a cumulative annualized operating income benefit of more than $20 million across both retail and wholesale segments.
20 million plus an operating income lift. Nice.
But wait, there's more. They also identified over $10 million in structural G&A savings. Corporate overhead they just don't need anymore.
So add those together. You're talking about a $30 million plus structural improvement to the bottom line.
At least.
Yeah.
That's the target. And crucially, those G&A savings, they're not just some future promise.
You mean they're already seeing them?
Yes. They confirmed it on the call. Q2 G&A was $40.7 million, down from $42.4 million last year. They said they're already capturing about a third of the first tranche of savings from the stores already converted.
Okay, so that's real proof the model is working, even as the headline revenue shrinks because they're selling fewer things directly.
Exactly. It shows the structural benefit is flowing through right now.
That's a strong baseline. But what about looking forward? Did they give any sense that maybe the consumer pressure is easing up a bit? I heard something about July trends.
Yeah, that was actually one of the most encouraging parts of the call. They gave some color on July trends.
Yep.
Same-store merchandise sales growth for July, excluding cigarettes, was actually up slightly year over year. Just slightly, but still positive.
Why is slightly positive such a big deal?
Because it marks a significant sequential improvement. They said it was the best comp performance they've seen in 18 months. And it was like 3 percentage points better than the trend they saw in Q2 overall.
Okay, so maybe a bottoming process or at least stabilization.
Potentially. And they also really hammered home the loyalty program. Sounds like that's becoming a real differentiator for them.
What were the numbers there?
Their big campaign, Fueling America Future, apparently drove a 50% plus increase in daily signups for their Fast Rewards program during the quarter.
Wow. And do those loyalty members actually behave differently?
Oh yeah. The data they shared is pretty compelling. Enrolled members spend about 50% more per trip, and they make roughly 3 extra trips per month compared to non-members.
50% more spend and 3 extra visits. Okay, I can see why they're pushing that hard. It locks in profitable behavior.
It's their main tool for driving those higher margin impulse buys we talked about.
Right. And you mentioned OTP earlier. Other tobacco products, that was still a growth driver.
Yep, still strong. Sales up another 170 basis points within that category. They also hinted at a potential tailwind.
What's that?
Potential FDA crackdowns on the illicit vape market and stuff like that. If some of that low-price, unregulated competition gets cleared out.
It gives legitimate players like ARKO more pricing power on their regulated stuff.
Exactly. And then there's the other big piece of the forward-looking story. The new store formats. This is about the stores they keep operating themselves.
Okay, tell me about this Pass Graves concept. Sounds a bit morbid.
Huh. Yeah, the name's memorable. It's their new proprietary food service concept. They opened the first new format store featuring it back in June in Ashland, Virginia.
And the idea is to put more focus on prepared foods.
Absolutely. It's a big strategic bet on food service, and the early results from that first store, they said it's showing clear outperformance in food service, dispensed beverages, other key high-margin categories.
Why is food service so critical for these guys?
Margins. Simple as that. Think about it. Gas margins are okay, cigarette margins are thin, but prepared food and good coffee. That can carry margins of 60%, maybe even more. It dramatically lifts the overall store profitability.
So the plan is to roll out past Graves or similar concepts to the stores they aren't dealerizing.
That's the strategy. Apply this high-margin food-forward concept to the majority of the retail stores they keep. It's about fundamentally changing the profit potential of those remaining company-operated assets.
Okay, so putting it all together. They're shedding lower margin retail operations via dealerization, locking in predictable wholesale income, and boosting the profitability of the stores they keep through food service.
That's the plan in a nutshell. Trading headline revenue for higher quality, more predictable earnings, and higher ROI on the remaining retail.
So what does this mean for the balance sheet? Are they stretched thin doing all this?
Actually, no, they seem pretty solid. Ended Q2 with about $875 million in liquidity. And interestingly, net interest expense was actually down year over year.
Down in this rate environment? How?
Lower average interest rates on their debt compared to last year. So that's a nice little cash flow positive in a tough environment.
Okay. What about CapEx? Did spending jump up because of these new formats and conversions?
It did step up. Total Q2 CapEx was $45.3 million. But there's a key nuance there.
Which is?
About $22 million of that was spent buying the actual real estate, the fee properties, under 22 of their locations.
Ah, so not just store remodels, but buying the land underneath.
Exactly. An opportunistic move. Owning the property instead of leasing cuts down operating costs long term, builds asset value on the balance sheet. Their core CapEx on actual store stuff remained pretty consistent. Think of that $22 million as a strategic investment, not just spending.
Got it. And finally, guidance. Did they change their outlook for the full year, given all this?
They hold it firm. Full year 2025 adjusted EBITDA guidance was maintained, $233 million to $253 million.
Maintaining guidance despite the macro worries and the July bounce. What does that signal?
Confidence. Reinforces they believe in the path they're on. They did give Q3 guidance too, projecting adjusted EBITDA between $70 and $80 million.
Okay.
And importantly, they said the Q3 guidance assumes modest negative same-store performance continues. So they're still being cautious about the consumer, despite that little July uptick, not getting over their skis.
All right. That sets the stage perfectly for our next segment. Time to put on our hypothetical hedge fund analyst hats.
Ah, the not financial advice segment.
Exactly. This is where we pitch a wild yet maybe plausible trade idea based purely on the data we've just walked through. Purely a thought experiment.
Okay, I'm ready. What's the pitch?
The pitch. Go long ARKO and short XLP, the consumer staples ETF, or maybe a pure play C-store peer.
Ooh, interesting pair trade. Long ARKO against the broader staples sector. What's the core rationale there? Betting on structural change.
It's basically an arbitrage play on perception versus reality. The rationale is that ARKO is trading at a discount compared to peers, compared to staples, mostly because of the optics of that dealerization program.
Meaning the market sees the big headline revenue decline.
Exactly. Sees the 16% drop and freaks out, potentially missing the fact that it's being replaced by higher quality, higher margin wholesale and G&A savings. They're missing the forest for the trees.
Okay, so the stock is mispriced due to headline anxiety. What's the catalyst that forces the market to re-rate the stock and close that valuation gap?
It's the combination of those structural levers hitting the bottom line. You've got that $30 million plus in identified savings from dealerization that puts a real floor under earnings expectations.
Right.
Then you add the margin boost from the new food service formats in the stores they keep. That's powerful structural leverage. So the catalyst is simply proof.
Proof that the model works.
Yeah. If same-store trends just stabilize, they don't even need huge growth, just stability like that July bounce suggested. And if those strong fuel margins hold up reasonably well,
then the market can't ignore the profit delivery anymore.
Exactly. The narrative shifts quickly from struggling retailer with falling sales to high-margin wholesaler with a growing high ROI retail kicker.
So the bet is really on rapid multiple convergence. You're betting the market wakes up, realizes the quality of the cash flow being generated by the wholesale deals and the improved retail.
And realizes that cash flow stream deserves a higher multiple, maybe closer to a staples company than a challenged retailer, resulting in, hopefully, massive outperformance against the slower-moving XLP.
Betting on margin dollars and structural change, not just revenue volume. I like it. It's definitely provocative.
It's a thought experiment. Okay, let's recap the really crucial takeaways from this deep dive for you. First, that big EPS beat was driven by surgical margin execution.
Right. 33.6% merchandise margin thanks to OTP mix, and that really strong 44.9 cents per gallon fuel margin. Profitability over volume.
And underpinning that was increasing clarity and proof points on that $30 million plus structural savings pipeline from the dealerization program. Those G&A savings are already hitting.
And looking ahead, the key things for you to watch are, one, the pace of those additional store conversions. Do they keep hitting those numbers towards the 500 plus target?
And two,
And two, validation of those new food-forward store formats. Do they successfully roll them out? Do they deliver the promised margin uplift across the remaining retail footprint? That determines the ultimate profit ceiling.
okay, great summary. And we'll leave you with one final provocative thought to chew on. Can a company like ARKO successfully hedge its own retail operating risk by essentially becoming its own landlord and high-margin wholesaler?
Yeah, if this model truly proves out, if they can de-risk the retail operation this effectively, it creates a really powerful structural arbitrage. You have to wonder if others in the convenience space might try to copy it.
Something to think about. Thanks for tuning in to The Deep Dive.